out at the accounting equation and see if we can figure out what's really going on here. You know that it's assets equal liabilities plus stockholders' equity. The assets, those are what you have. You could have a truck, okay? So actually, the first thing you'd have to have is some cash to do something with if you're starting up a company. So you might need some of the asset cash, okay? So say you've got, $10,000 in cash. Well, where did you get it? Well, probably you're just starting a business. You didn't borrow it, so you don't have any liabilities. But you could have some have issued common stock, and somebody invested, probably you invested $10,000 into the company. So we've got cash, the asset. It's going to provide us future economic benefit, and it's equal to 0 plus 10,000 common stock. Okay, so we go out and we buy a truck. A truck is another asset. Okay, so we're going to buy a truck. So let's say the truck cost, $20,000. We have a $20,000 truck. So maybe we had to put down $5,000 in cash to get it. Okay, so there's the $5,000. Cash went down $5,000. And then we took out a note payable for the rest. So now we have a liability, a note payable on the truck for $15,000. Okay, let's not get too crazy here. Let's just back up. The first thing that happened, you need some money when you're starting a company, so you issue some stock. And the first owner's investment, you're going to say, yeah, we have an owner who owns $10,000 worth of the common stock, provided the company with $10,000 cash. That kept our accounting equation so that this equals that plus that. Now we go and buy a truck. A truck is an asset. It's going to provide us future economic benefit. So we bought a truck that cost $20,000. We paid $5,000 cash. Okay, so now our cash has come down $5,000, so we've got $5,000 left in cash, and we've got the $20,000 truck. So if we totaled this up right now, it would be we would have total assets of $25,000. We'd have the $20,000 truck plus the $5,000 cash, okay? And then if we total up the other two sides, we've got a note payable of $15 plus the common stock of $10, okay? So we have got 25 equals 15 plus 10. See how that works? That's really not so bad. But I want to talk, before we go any further, and that's all the numbers I want to do now, I just had to get the truck on here. This truck is an asset, provides future economic benefit. Now what we are going to do is, I'm just going to leave this here, what we're going to do is to start driving the truck around and generating some income. So let's say we go drive this truck around, and we go out and we do some work, and we earn, $1,000 in revenue. So when we do that, and I'm just going to say we got paid cash, maybe we've got cash that came in of 1,000, right? And we come over here, and we go revenue, 1,000. Okay. Now we had to pay for gas and other stuff on the truck, and so let's just say that we had expenses related to this of 700. We had supplies, and I'm just going to lump that all in, and so we're going to say we had expenses, and that's all of our expenses for the month of, say, 700. Okay. So let's look at what we did. We had cash put into the company. We went out and bought a truck. We paid $5,000 cash, took out a note for $15. Now we've gone out and done some work. We brought in $1,000 cash revenue, and we paid out $700 in expenses. So let's just see how this works out. If we use this as our starting point, and we filed a financial statement, what would our balance sheet look like? Here's our balance sheet. It's just, I had said it's a glorified accounting equation. We would have assets of $10,000, which would be the cash. And we would have stockholders' equity of 10,000. And we know that our assets equal our liabilities plus our stockholders' equity. So that's where we started out. Now, we went and drove the truck around, we did some work, and so during the month, we had revenues of 1,000, and then we had expenses of 700, so we had net income of 300. I'm not paying any dividends, just not to confuse things. So this would be our income statement for the current period. Okay, so now we do a retained earnings statement. We started at 0 because our company just started. Whoops, that's kind of a mess. Okay, beginning was 0. Net income 300. Dividends 0 because I'm not going to confuse things. And so our ending retained earnings is 300. Okay, so now let's do an updated balance sheet. We still have we have to update everything that happened here. So now we've got the assets. We would have the truck on the books for our 20,000, right? Let me get my numbers right here. We've got the truck on the book for 20,000. We've got our liabilities of 15,000. That's the note payable. And then we also have the asset cash. And cash, we had 10,000. We spent 5,000. That got us down to 5. Plus 1 is 6. So it looks to me like we have 5,300 in cash. Okay. So if we add this up, we've got 25,300 in assets. So 25,300 should equal 15 plus our stockholders' equity. And so now's the time we see if I've totally goofed this one up. So our stockholders' equity, we have the common stock for 10,000, right, from here. And then we've got our retained earnings of 3. So if that's a total of 10,300. So if we go plus 10,300, 25, oh my goodness, it worked. Isn't that amazing? Okay? I'm just trying to give you a general sense of how this works. We start with a beginning balance sheet that gives us a picture of what we have at the moment. So we've got the assets of 10 and the stockholders' equity of 10. That's the end of the accounting period. The balance sheet summarizes what's happened so far. Then we start a new accounting period. So say this is the end of 2015, and now we're into 2016. This is all the stuff that happens there. So we go out, we use the truck, we use our assets to generate income. So you'll notice that, and so we're out there, we're making income, we're paying expenses, and we end up with net income. At the end of the period, we do the income statement, and we see how much income we've made. Then we do the retained earnings statement. Started with 0, plus the net income, no dividends, ending. And then we prepare, based on all of this, we have to update the balance sheet to see, well, what's happened since we started? What happened in this period? And we get a new updated balance sheet at the end of the period that now has the truck on it. It has how much cash we have left. We took out the note. We made some money. Okay? So that's generally how this works. And the transactions, every transaction that happens, it's going to have 2 parts to it. It's called double entry accounting. So cash came in, we got it from our investors. Cash came in, we got it from revenue. Expenses, cash went out, it was for expenses. It kind of explains what has happened, and it keeps everything balanced. Okay, the difference between an asset and a revenue. Think about yourself personally. Say maybe you've got a car. That's an asset. You need the car to go to work to earn some income. But that income is not an asset. The income is what the asset enabled you to do. The car got you to the job so you could do the work and get paid. So the revenue is sort of the activities of your business that the assets make it possible for you to do. Okay? So hope that helps a little bit.